All right, and we should be live here now. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for what has become a regular event on the Thoughtful Money channel. We just had another guidance release from the Federal Reserve's Open Markets Committee, followed by a press conference by Fed Chair Jerome Powell. Fed-watcher Axel Merk and I are going to react to that live here. And then we're going to take your questions. If you can't watch the whole thing, don't worry. This will turn into a replay video at the end. If you're watching this on replay, welcome. All right. As I said, I'm joined here by Axel Merk. He's the President and Chief Investment Officer of Merk Investments. Axel, how are you?
Great. And I took on this jacket for you for the occasion to talk about the somber events at the Fed.
Yeah, as I told you, you didn't need to wear the jacket. I have to. I'm the host. You can be a lot more relaxed. Well, very quick, let me just give folks the punchline. The Federal Reserve introduced another rate cut. They cut their policy interest rate by 25 basis points. It's now down to 4.5%. It was a unanimous decision this time. You might remember last time there was a very rare dissent on the committee, but this time everybody was unanimous. There's no change to the pace of quantitative tightening. So quantitative tightening is still continuing. The Fed is continuing to reduce its balance sheet. It is not altering the pace of that, at least in no statement today. So anyways, folks, I've got a couple of prepared questions for Axel. Some of you submitted questions early. I've got one or two of my own. We'll get through those first, and then I'll just start taking live Q&A from the audience here. So as you are participating in the live chat there, just type in your questions and I'll do my best to surface as many as I can during this discussion. If you can too, just let us know where you're watching from. That's always really helpful for us to see. All right, Axel, I guess first question for you, just any surprises here?
Any surprises? The goal, I think, in today's meeting was not to surprise. And for the most part, I think Powell succeeded in that. Before I go on too much, though, I think when we talk about the Fed, and I do this all the time, so apologies for those who have heard me say this before, we need to just take a second to think about why do we care about any of this, right? Why do we care about the minute details of what's happening at the Fed and whatnot? It is because the Federal Reserve sets the anchor of what is, at least by regulation, the risk-free rate. All our assets are priced off that. So if you're an investor, you should care. We're talking about big bucks. The Federal Reserve affects trillions in the world. And so when the Fed speaks, we listen. The reason why we listen when they just speak rather than only act is because the longer term rates are affected by what the Federal Reserve says. In part, it reflects the confidence on the rate path, in part on the inflation, on the growth potential of the economy. We had some changes there yesterday with the election results and so forth. And so in that context, the Fed also doesn't want to be a political, and we'll talk about that, I presume. And as such, it's really, really difficult for the Federal Reserve to have any drastic changes 2 days after an election. I think it's very noteworthy, and because in the context that the market, of course, decided there was a change, there was an election. And there, at the other end of the spectrum, you have a debating club, that's my name for the FOMC, that is really tied to not reacting to that. By setup, by process, they're reactive. But they're not reactive to changes in the market unless the wheels are falling off. They're reactive to economic data. And as they communicate, they say, oh, if unemployment changes, oh, if inflation changes. Well, we had an election. Unemployment is not going to change overnight. Inflation is not going to change overnight. But clearly, the path forward is going to be different with a different administration. And at the same time, their hands are tied, and so they rather shut up and not say anything. Of course, that will also happen as we go forward to the extent we have regulatory or tax changes. They will say, hey, we can't act on something that might happen, which is one of the many reasons why I think the way that the Federal Reserve approaches all this is a bad idea. And they, as a quote-unquote debating club, are going to be late with whatever happens, and it's going to contribute to volatility rather than than mitigating it as they want to do.
All right, Axel. So we'll talk about this in a bit later, but it actually came up in the Q&A with the press, where Powell said, "Hey, look, we definitely don't want to get behind the curve here," but it sounds like you think they are going to be, may already be.
Well, by institutional setup. I mean, what we had a 50 basis point rate cut. We have a 25 basis point rate cut now, and one of the things Powell said is he wants to slow the pace as they're getting to neutral, and he implied that when they're at neutral, they're not going to pause. They slow the rate of cuts, which means he's signaling that he wants to have an accommodative policy. And I'm just wondering whether that is appropriate when sure, inflation has come down, but there's no guarantee that inflation has been completely beat. Indeed, there are, I think, plenty of arguments to suggest that it might flare back up at some point. Unemployment rate is still very low. Sure, the economy has slowed somewhat, but it's not like, at least based on the figures that we see, we're falling off a cliff here. And so the question is, should the Federal Reserve really go beyond neutral? And Powell, of course, left himself a lot of wiggle room that he can pause any time, but the signaling he's giving, and the signaling is important, suggests that he wants to go beyond neutral. And so he is not worried about hitting the neutral rate, which is a rate, by the way, that is unknown and it's unknowable. And so he doesn't seem to be concerned about that and wants to go through it, which is a stimulative to the markets, because it means that the Fed is, we're in the higher for longer environment. You didn't want to fight the Fed. Well, now if you don't want to fight the Fed has your back.
Okay, and folks, I see you asking questions, which is great. I'm going to start, pulling from some of the prepared and some of yours. I'm going to try to pick questions that lots of people seem to be asking here. Axel, so I'll see if I can share this, but the market's expectations for some of it this way. Powell many times said, look, we're gonna continue cutting until we get down to neutral state, right? And so the expectations he's setting are for future rate cuts. On what schedule, he's not committing to. He keeps saying we're going to be data dependent. We'll let the data decide. But he is definitely setting expectations that the Fed will continue cutting from here. Rate cut odds for December, if I'm reading the CME tool right, plummeted from around 71% yesterday to 0 right now. So, am I reading that correctly? I mean, is the market thinking that the Fed is one and done? Okay.
No, you're not reading it correctly. At least not from what I see. If I look at my live Bloomberg fancy thing, the futures market, they were in the 60 percentiles range, and currently we're at 71% chance of a rate cut for December. If you look at the OIS market, it's a 56% chance of a rate cut. So a cut is still firmly priced in. I think on the broader side, if one just goes for more than a day or so, in September versus September, and now we've taken out almost 4 rate cuts over the next year, and so the market has gradually become more hawkish, so to speak, that fewer rate cuts are needed. And so obviously it's a question whether we have that December rate cut. We do have some economic data coming in, but of course we don't have come in is any new policies. We have some ideas of what the Trump administration might do, but it's not going to be reflected in the non-farm payroll report. It's not going to be reflected in any report that we're going to get. And the Fed is, of course, backward looking. And so it is very, very difficult for them to judge that. What they can see, of course, is they can see mortgage rates that have bumped a little higher with rates backing up on the long end, and they may not like that. And so that might be one of the reasons why they may, all else equal, be inclined to cut a little bit more.
Okay. Well, let me just do one thing here, just so you can show what I'm maybe misreading here. I'm going to share. Do you see the screen here, Axel?
I do not, I'm afraid. But
It's not
maybe
pulling up, huh? Sorry, folks. Let's try this one more time. How about now?
there we go.
Okay. So if you look at the CME tool, 1 day ago, they were predicting a 69.9% rate cut by the December meeting, getting us down to 425. Now it's saying 0. Now, maybe the data here just hasn't populated. I just thought the market really changed its mind after Powell's press conference.
Yeah, I'm not familiar with this particular interface. It could be referring to today to no additional rate cuts. I do not know where it is. I look at my fancy Bloomberg screen, and those are the numbers I gave you. So that might just, I can look at it at some point and then give you feedback. I'm sure they're looking at somewhat the same data, and there's probably just a different way of reading it. And sometimes when you read them the day of an FOMC meeting, one has to do certain things to
right, and there might be a data
too.
issue there, but at least I'm hopefully don't feel like I'm going crazy. I was looking at the data, the data correctly. It just might not be right data. Okay, but this my questions about expectations tie back to some questions that came up several times for Jerome Powell in today's meeting, which were, hey, Jerome Powell, I think the words he used are the economy is, quote, strong. He kept talking about consumer spending being resilient, same with capital investment spending, that the labor market is normalizing, but looks really solid, right? Very, very positive language that he's using to describe the current economy and GDP growth. And so people were saying, okay, so then why cut, right? Everything's great. Why are you cutting? Right. And Powell gave his best answer to that, which was sort of like, well, we've got confidence in the trajectory that we've engineered here, and we don't want to over tighten, and stay too high for too long. But I think there's a lot of people that are still scratching their head and saying, like, a lot of this, a lot of the steps you're taking, you typically take, especially like a 50 basis point rate cut, from last time, you typically take when you're worried about the economy, but you keep telling us how great it is. So help square that circle for us, Axel.
Well, the goal again by Fed Chair Powell was to say as little as possible, right? Let's not forget that. Part of it is not to get political attention 2 days after the election. I think he pretty much failed on that because he got 3 political questions, which I'm sure we'll talk about. Part of it is he wants to have a consistent storyline. Now, he did say, by the way, that the economy was overheated a few months ago. And that is something that is that was somewhat surprising because I hadn't heard him use that term before, which again should suggest, hey, why on earth are we cutting as much as we're doing, right? So I don't think any of that is warranted. Again, I can just say that his bias is that he wants to cut. Powell is somebody, he was appointed by Trump, by the way, and survived the Biden years, and his term goes until May 2026 as a Fed chair. And he has always wanted to err on the side of being a bit easier. It's one of the reasons why we're so late in hiking rates. One of the things he said why he can't say what's going to happen going forward is because we don't have any summary of economic projections. That's when all the FOMC members give their forecasts. That said, that forecast used to be completely written off, and now suddenly it's become super relevant in Fed policy making.
Okay. I want to pull on a thread in just a second of your reaction to Kevin Warsh and his appearance on CNBC the other week, because I think Kevin maybe shares a lot of kind of your similar thinking. Real quick, a lot of people are asking about Trump's relationship with Powell, because you mentioned that Powell was a Trump appointee. First off, I just want to note for folks that didn't watch the press conference, was several times they tried to engage Powell for commentary on, what do you think of Trump's policies coming in? Is Trump going to fire you? Can Trump fire you? And basically, Powell, when it went into the political realm, you could just see his face change. And he basically said, I'm not going to talk about anything political. So he didn't want to touch it with a 10-foot pole. But when asked if Trump could fire him, he said no. And if asked to leave his position early, he said no. And those were one-word answers. He wasn't going to allow himself to be goaded to explaining in any greater detail than that. So
he did give the long answer that the law doesn't allow it, right, or something like that. It's not consistent with the law. And
that one sentence was the long answer. Yeah,
that was his long answer, and that was just when he was asked directly. And there is, aside from, of course, it might be entertaining to watch, but there are a few things to it, right? One is the political side of it. Earlier today, there was a headline out that Powell would let him stay until May 2026. Obviously, if there's no choice, he will let him stay, and that's most likely the case anyway. And of course, if Trump hears that he says no, maybe he'll react to that. That said, again, right, why do we care? And I think it's important to remember that I'm very critical of the Fed policy, but it must be the case that there's always only one chief in town. Monetary policy is more effective when you have one chair who says something, the market listens and absorbs it. It's more expensive if the Fed has to move rates or if you have to engage in QE or some other special measures. When there's credibility at the Fed, it lowers the cost of borrowing. It's better for the economy. So if you have a credible source that torpedoes what the Fed is doing, that increases the cost of doing business. It's bad for the economy. And that is why it is not good to have the executive, have the president or the president-elect interfere with what's happening at the Fed. If Powell can credibly say that it doesn't matter what what Trump says, he can say whatever he wants, I'm not going to leave, and he's of course not articulating it that way. But if that is credible, then all is good. Then Trump does his politics and he does his monetary policy, and we all live happily ever after. And I think it's motivated by that he gives these very short answers and just says no. And clearly he had looked it up, and of course it's a question, why the heck did he have to look it up? And it's obviously everybody knows the answer to that, right? But there is a good reason why he gives these short answers, and it's actually the right answer to give.
Yeah, and I know that you have said many times, hey, the Fed should just say a lot less anyways, right? But I understand that, hey, if we're going to have a Fed and it's supposed to be independent, we want the Fed to project that independence and to speak, with its one voice and not have the market wondering, okay, wait a minute, who's driving the show here? Is it the Fed chair or is it the president? Now, these two have a bit of a history, though, right? Powell was appointed by Trump and came under a lot of pressure, which many people from Trump in the first administration, which many people attribute to what was called the Powell pivot, right? So I'm just curious, asking you to prognosticate here, Axel. Do you think that Trump and Powell are going to have kind of a contentious like a publicly contentious relationship here going forward, or have they both learned their lesson?
Well, is Trump not going to be Trump? I mean, it's they are what they are, right? Powell has a job to do, and Trump has a job to do. Trump is going to be a politician, and Fed is going to be and Powell is going to be a Fed chair. So if Trump sees it politically convenient to comment, I mean, the Federal Reserve has always been a favorite punching bag of politicians. When something goes wrong, it is of course the Fed's fault, right? Just regardless of my criticism that I have with how the Fed goes about things, politically speaking, it is popular to be critical of the Fed, and that's not going to change. Now, you mentioned Kevin Walsh before. As those who are old enough may recall, when Trump was chosen to be first nominated and then appointed to be Fed chair, Trump had made the comment that Kevin Warsh looks too young. He doesn't look the part of a Fed chair. And not everybody of the audience will know him, but Google him. He is, I mean, he's obviously aged a little bit, but he's a good-looking man, right? He looks younger than his age. Is a fit man, and he has spoken very sparingly. Of late, he has spoken a little bit more. I wouldn't be surprised if that is in part because in May 2026 you want to be again on the short list of candidates. And you mentioned a CNBC interview where he's been fiercely critical about the Fed, and in a few words, he has kind of ripped apart and that everything that the Fed has done. And I think he made some very good points in that interview. And I think we have a stalled image again from you, Adam. So while you sort that out here, I think, and I'm not going to put words into Kevin Warsh's mouth here, but here we go. Now we are.
Yeah, sorry, Axel, and sorry everybody else. Normally I would reboot my computer, but that takes a couple of minutes. So I think we're just going to soldier on with me having to pop in and pop out as this happens. Axel, so you mentioned there that you thought Kevin made some good points. If you could you just note one or two or three of the top points?
Yeah, you're putting me on the spot here, and I was trying to punt that because I hope that your notes would be so good, because I heard him speak at a conference also the other day, and then I don't want to mix it with my own opinion, and that's why I was hoping that you had this right in front of me. But I do vividly remember that he was kind of 1, 2, 3 punches he gave.
Yeah, certainly one of them was the Fed doesn't have a framework, which has been a saw that you have been playing for a long time here.
Exactly, and I don't want to mix my views with, I don't want to put words into his mouth, right? Because I do happen to agree with a lot of what he does. But yes, and not having a framework, right? It goes through this conflict that's out there that discretion versus rules-based policy, and the dominating view on the Fed is, oh, you need to have discretion, you need to have a debate. Whereas the other camp is, you got to be clear of what you're going to do. There's got to be a reaction function, and maybe there's a reason that you could override that. But at the very least, you should articulate what is it exactly that you're taking into account, and what you're doing to move forward with that. And that is not the case. The folks at the Fed, they love that. Not everybody, but those who have the influence and have the power, and they don't want to give up that power. That said, that power has gotten us, as in the consumer, the economy, into a lot of trouble, including the great inflation we've had now, the great inflation of the 1970s as well.
Okay. Look, let me move on to one of the two of these things here. I guess so. You know, Powell's term is up in middle of 2026, right? Who is on the short list? And Warsh may be one of them, but who do you think is on the short list to replace him?
Well, I think it's a little bit too early for that silly season to start. Kevin Warsh is one of them, I presume, right? Judy Sheldon has been trying to position herself to be on that list. She was a bit too off the mainstream to be acceptable to the Senate, and so we will have to see. There will be others, right, that will come in. It really depends on. We'll see in the coming months of what sort of administration we'll have. But for what it's worth, Kevin Warsh, I think, would be an excellent choice, because he was a governor, had executive experience there at the Fed as well during the financial crisis, and has intellectually a very deep bench. He embraced AI for what it's worth way before it became mainstream, saying that we got to go much broader than the models that they use at the Fed, and so he has he is certainly a younger generation that is in my view more focused on price stability than many others are that are likely contenders down the road. Now, that said, of course, the other thing is that Trump has said before he wants to have a weak currency and a weak dollar, and so having somebody who is super hawkish might not be his cup of tea. And so it's in that context that while I think Kevin Walsh is more on the hawkish side, he does emphasize the rules-based approach quite a bit.
Okay, because you just mentioned Trump wanting a weaker dollar, let's say for a moment that he's successful in that, right, by whatever means. We've seen gold have a great run this year. We've seen Bitcoin have a very big recovery this year, and then it's done very well since the election because Trump has made some platform promises around Bitcoin and cryptocurrency in general, I believe. So if Trump was successful in engineering a weaker dollar from here throughout his administration, would that de facto put a tailwind against assets like those as well? Would you expect those to go even higher?
Well, the first I'd like to say it is much easier said than done to engineer a stronger or weaker currency. We're not in China. We have market forces that guide these things. One way to think about the dollar and the U.S. is that the U.S. is a huge hedge fund that borrows cheap. It's like you borrow cheap in U.S. dollars and you invest with higher yields abroad. Many foreign countries borrow in the U.S. because it's cheaper to borrow because they're deep capital markets and then invest in their countries, which means when risk is on, the dollar tends to be weak. And when risk is off, you reduce your leverage. That's a short squeeze, which means the dollar is strengthening. So that's been kind of one of the big themes that's out there, and that's why you often see some counterintuitive reactions. A big other driver that's out there, and that's more the folks that buy alternative assets, and as I think your audience knows well by now, we manage about 1.7 billion in gold and gold mining, so we are somewhat biased on that side of things. But a lot of investors in that space are concerned about the long-term sustainability of the dollar, given the deficits that we have. And as a reminder, neither Harris nor Trump really had an agenda to fix the deficit. And when I talk about fixing the deficit, I'm talking about entitlement reform. Clearly, you can cut waste, you can save some money on that end, but if you don't cut or reform entitlement so that they become sustainable, you're going to have some issue down the road. And we also know that in the previous administration, right, Trump was more interested in tax cuts, saying that's going to give you enough revenue down the road. And I don't disagree with that, but that's wrong. But that doesn't sound like something where we're going to move towards an environment where the dollar is going to be super strong. So he might, quote unquote, engineer a weaker dollar by pushing growth, by pushing deregulation. Pushing deregulation might increase the dollar. I'm sorry for switching back and forth here. When you push deregulation, the real potential of the U.S. is higher, and we saw that yesterday when interest rates bumped. Yesterday, the gold went down. Today, gold went up, right? Because today people remember the Federal Reserve is there as well, who's going to be dovish. So there are all kinds of cross currents. Which one of them is going to prevail at the end of the day is going to be difficult to say. I look at the world in terms of risk assessment of what might happen and what sort of scenarios do I have to take into account. But a broadly a global economy that's growing tends to be causing a dollar to weaken. A risk-off environment tends to be stronger for the dollar, and of course the other portion of that, which is the diversification of central banks. Ever since the U.S. and the European Union started to seize the foreign reserve assets of Russia, we've seen a breakdown in the correlation between the price of gold and real yields. And what that to me suggests is that foreign central banks are incentivized to diversify beyond the dollar, something that's much easier said than done, but it is something that is one of the drivers of currency markets. the metals. And since you mentioned Bitcoin as well, I think the key thing here is that Trump has made it very clear there's a lot happening in the digital asset space. He thinks that should happen in the US, and the regulatory environment needs to get up to speed on that. And so I think that's going to help the entire industry. And the one thing that comes to mind right away is poly market. There's no reason why poly market should only, that's the betting market that was in the news for the elections. There's really no reason why that should not be accessible to US investors, because that's a truly useful implementation of blockchain technology. Whether that will translate in any particular cryptocurrency going through the roof is, of course, a completely different question.
Okay. We're gonna pretty quickly, Axel, get into kind of lightning round mode, because there's a bunch of user questions, and we're only about a half hour to go, so we're gonna have to try to squeeze in a bunch. That being said, I do want to talk with you in just a second about the fact that since the Fed made its 50 basis point cut between then and today, I think the 10-year yield has risen by 80 basis points, right? And that came up a little bit. Actually, it came up a number of times today in the press Q&A with Powell. We know his answer, which I'll summarize in a second. I'd love to get your thoughts. Very quickly, though, we just had a very generous donation made to get this question asked. So Green Spud Trades asks, why do we even have an FOMC? What would happen if the market decided short-term rates instead of the government? And I know this has been proposed many times. I think I hope I'm not misremembering, but I think even in my last discussion with Lacey Hunt, he thought we should maybe go this route. But why don't we just have a market set short-term interest rate?
Yeah, wouldn't that be good? No, of course that would be much better. And in some ways, of course, it happens because it's in the market. The Federal Reserve is usually following what the market is telling them, and it's just happening with a lag, and sometimes with too much of a lag. And so if the market were telling us what to do, I think that would be very helpful. If we had a very simple Fed policy that set rates based on a simple formula of inflation and unemployment, the market could price that in, and then as the market knows what inflation and employment is going to be, that's going to get priced into the market. I mean, that could be a much, I think, more fruitful way of conducting Fed policy. But yes, ultimately the market is coercing the Federal Reserve what to do. It is rare that the Fed is proactive and looks ahead a little bit. Greenspan did that a bit on occasion, more so than others have. But it is something that I think that would be very helpful. And ultimately, of course, the Fed is hostage of the markets, and we see that, of course, in extreme cases when there's a crisis. But if we allowed, and that is one of my big criticisms ever since the financial crisis, we've taken more and more market-based measures away, and we think that the sledgehammer of the Fed can be all the more powerful. And that the problem with that is, amongst others, that we're taking gauges away, and so the Federal Reserve is reading the same tea leaves that you and I are reading, and you and I may have an opinion, but we certainly don't have a crystal ball. And the same applies to the very, very human beings at the Federal Reserve. And if they acknowledge that, not just by being humble in the speech, but in practice by actually deferring to the market, I think that would be very, very helpful.
Okay, and Axel, I mean, is there a process or a mechanism by which we could get to the point at some point where they say, we should have tried it with this FOMC, but we actually think a market solution might be better, and let's go to that? Or is this sort of like expecting Congress to pass term limits, right? It's just like not in their self-interest. They're just never going to let it come up for a vote or pass because it's against their personal interest.
You would have thought after the big mess up with the great inflation we've had, there would have been a reason to have enough impetus to change the way a Fed operates. But none of that, right? Not from Congress and not from the Fed itself. The Fed still has the backward-looking inflation averaging as its goal. They still say that they did nothing wrong in the great inflation. It was kind of bad luck type of thing. And yes, they'll do their review. They have not acknowledged that this has been a big mess up. And it's, of course, not the first one in monetary history that the Federal Reserve has messed up big time. You would think in any other institution, in the private sector anyway, that would lead to a review of what should be changed. Instead, what's happening and what has happened in 2008, the governors got more power. They devoted the influence that the presidents have. The Federal Reserve. I mean, we talk about the Fed funds rate. Who cares about the Fed funds rate, by the way? The rate that is relevant for most people is the interest rate that's paid on reserve. That is not decided by the FOMC. That's decided by the governors. There are other rates in the market that the Federal Reserve has very, very little influence on. And in that sense, right, the market, if anything, right, with all these reserves, they have this huge balance sheet. With all these reserves in the system, the Federal Reserve actually has some issues trying to control the rates. And so they're trying to coerce ever more what they want to have. I think they have it all backwards. They should start with the market and then have it driven that way. And I preferred the environment where the Federal Reserve would intervene in the markets to set the rates when you have this channel in which the New York Treasury desk would do it. The folks at the Fed think that the current system is much simpler. In some ways it is, but you're also, I think, losing a lot of information from the market. And by the way, even the old system didn't let the market drive things entirely, because in some ways they set both the price and then they managed the demand. And so that is also not perfect. I mean, ultimately, central banking is a messy deal, right? And ultimately, you can get away with mediocre monetary policy when fiscal policy is in good shape. When fiscal policy is in bad shape, good monetary policy can't rescue you either.
Yeah, and I did think it was interesting that Powell was clearly not looking for a fight, wanted to stay in his lane, didn't want to answer any questions about Trump. They did ask him several questions about his thoughts on rising deficits and on issues that was creating. And he kind of tried to evade the question until the very end. And then he said, and I'm trying to find my notes on it, but he basically said, well, let me just be really clear on this. Here it is. The federal government's fiscal path is unsustainable. The debt level currently isn't at existential threat levels, but its trajectory is, right? And he said, I think I've been clear on that. I'm clear on that, right? And so he is willing to kind of point that finger, but
now he is. He has not been clear on that. Now he is. He's gradually getting to that stage, and I don't think it's a coincidence that he's getting to the end of his term in a year and a half. That he's starting to get. Greenspan used to talk about it all the time. Bernanke then reduced it, and Yellen didn't talk about it either. Said, no, it's not our problem. It's not our problem. It's our problem. It is our problem. It is the Federal Reserve's problem, because ultimately, as Draghi has showed, right, a central bank will do whatever it takes. So when push comes to shove, the central bank will bail out the government. And one problem with you talked about quantitative tightening. One problem with that is that there are folks in Congress that think they can use all that money that's at the Fed. So it is not a good idea. There are some of these things that the academics say, oh, it's not a problem to do it this way or that way. It is a problem. It is a problem because it draws the politicians into that. And the Powell Fed has not been great in trying to stay out of it. And I'm a bit of a purist on that, by the way. I think the Federal Reserve should exclusively focus on monetary policy, and even something like buying mortgage-backed securities is not monetary policy because it's directing money to a specific sector of the economy, notably the mortgage market.
All right. Well, I'm right there with you on that one, brother. Amen. All right. So I want to get to the question now about rising bond yields on the longer end of the curve, which obviously the Fed doesn't have control over. Neil Smith asked a question that's somewhat similar to what I'm raising here. So the bond market reacted to the 50 basis point cut by increasing bond rates. And again, 10-year up 80 basis points since the 50 basis point Fed cut. What's the likelihood of further interest rate cuts triggering further bond yield increases? And I'll tack onto that. And what will the implication be if those higher bond yield increases materialize?
Well, the question, I guess, is what's driving these higher yields. And as a reminder, the yields went up with the election results coming out. They actually came down today. And so it's not because of rate cuts or rate hikes that they went up. It's because of a new administration coming in. And there you can read, is a new administration coming in, is that going to lead to more inflation? I think it leads to the answer though was in the real yields. The real yields that are priced in, and that's the yields in the TIPS market, suggests that the real yields move higher, which suggests that the growth potential is higher. Right now, clearly, if the market were to think that the rate cuts would trigger inflation, you would see that as well. But long-term inflation expectations haven't really moved in recent days. They maybe a tad higher. I think they want to see a little bit more substance of the sort of policy changes that might get proposed. There's a lot of speculation of what might happen. One thing I mentioned, we do gold mining. We in our internal meeting we said, well, permits for mining projects, for example, are going to get easier, right? The same, of course, for oil, strategic minerals, gold, whatever it may be. And so and those are projects that take many years, and those become easier. And so there's going to be more demand for long-term assets. So it's in that context that I see higher yields. A Federal Reserve that cuts aggressively, that did lead to maybe answer the question that was asked, to cut aggressively when the economy is somewhat hot. Yes, that can lead to higher yields. I just didn't see it today in any of the numbers.
All right, and Powell basically said, look, we're watching it really closely, but we don't see it as being a major issue yet. And he said, look, if it stays elevated and keeps going higher, yeah, we're going to have to really pay attention to it. But whether he was just having a good poker face or being honest, he was just saying, it's really nothing. He said it's not factoring into our models at this point in time. So I think he expects it to be relatively transitory. Now, if it proves as transitory as inflation did, he might have a problem on his hands. All right, folks, get a few more questions I'm going to get to, though, but just do me a favor. If you are enjoying this live reaction to breaking developments in the world, would like to see us continue to do more of this. Again, like I said, these post-FOMC discussions are kind of becoming a bit of a tradition. But if you'd like to see them continue, if you enjoy it, let us know in the comment section here, because obviously we want to do more of what you like and less of what you don't like. All right, Axel. I want to talk about the balance sheet for a second with the Federal Reserve. I saw some chatter online about the Fed bids for 4-week bills totaling about $275 million. And the chatter around that was, wait a minute, is the Fed back in the market, buying bills? Is there anything to this, or is this just them, kind of managing the roll-off on the existing balance sheet?
They probably just managed the roll-off, right? I mean, they want to keep things simple. They don't want to reduce the balance sheet too much. It's one of these things, right? They know they want QE when things go rough. They have no idea how to shrink the balance sheet effectively. To what point? I mean, of course, they know how to not to reinvest things. You have a lot of treasuries being issued. As there hasn't been much emphasis on that. They'd rather like to just have that problem go away because they don't know how to manage that, right? It's very difficult to say what the impact is. I think the biggest impact is that they get so overwhelmed with the new issuances of the debt that they may well lose control over setting the short-term rates. In which case, hey, maybe people will get what they want in the market, right? Because again, the Fed funds rate, there's very little in the market that depends on the Fed funds rate these days, and so then they're kind of being pushed, doing this with interest on reserves. It's one of the reasons they have a channel, so that they have some leeway and not too much egg on their face when they miss the target. But one of the challenges they have is at the end of the quarter, the way that foreign institutions are regulated, they need to square the numbers as of the end of the quarter, and so you can literally get inundated with deposits at the Fed and whatnot. There's so many regulatory rules on what people have to hold in cash and whatnot that might overwhelm where they want to see interest rates. And different types of institutions have different rules, and so the entire system has just gotten way too complicated. And I think, maybe Elon Musk should clean up at the Fed a little bit. That might be an interesting one. I don't think
would that fall under the umbrella of Doge? Does the Fed fall under a government agency?
Let me just briefly. Everybody will hate me when I say that. I think this idea of having a crypto reserve is complete bogus. As I said earlier, I think absolutely the digital asset space is going to thrive in a Trump administration, in the sense that new technologies will be developed. But as far as reserves are concerned, the Federal Reserve, the ECB, some central banks have gold. They don't quite know what to do with that. They want to hold on to it. They certainly don't want to give it up. But they institutionally are just not wired to take on some other asset. And why on earth Bitcoin? Just because Bitcoin enthusiasts love it? I think that any such drive would take many years, and that the rationale which we need to develop. Now, I'm not making a forecast here on whether Bitcoin should be higher or lower. The market clearly indicated that they like the election, and I think for the right reasons, because digital assets are going to be more accessible. But that doesn't mean that central banks will embrace, I think, Bitcoin in any which way anytime soon.
Okay. All right, Axel, I'm going to ask you to put on your prognosticating hat here for a minute. Steve asks a question I think a lot of viewers of this channel are probably asking. They'd love to hear your opinion on them. Where's the bottom in TLT, which basically is the same way of asking is where will longer term bond yields top out here? Do you have an opinion of where they're headed?
It's impossible to say, because it really depends. When we have an election, everybody gets all excited, right? For better and worse. Oh, the good guys are winning, the bad guys are winning, and now all the problems in the world are solved. The one thing that most presidents will tell you or have said once they go out of office is that they have moved the needle a little bit, but they've only there's so much work to be done, and they've only achieved a little bit. And so if you have somebody who says, oh, I'm going to get rid of all the regulations, well, guess what? Just like the CPI index rarely ever goes down, the regulatory needle, it's usually the pace of increased regulation that slows down. Now, this time around, there is a chance that regulatory burden may actually come down, but I'd like to kind of see the proof in the pudding. I think we can do a lot in the approval processes and whatnot. If I look at my industry, I don't think most of the regulations we have in our industry are going to disappear. I think the rate of growth is going to come down, and maybe some of the other ones are going to go away. It's a huge, what regulation is, it's a barrier to entry. It helps the establishment. It makes more difficult to start a young company. And the reason I mention all of this in the context of this question is because it's the growth potential that ultimately drives the long end of the yield curve. The other driver is inflation. And there similarly, we just don't know, right? We don't know what the policies are going to be. I could well imagine, and this is pure speculation, that this is an administration, let's think about it, right? It is an administration that's going to be a lame duck administration from day one. It's an administration that doesn't want to be a lame duck administration, which means they're going to try to push through as much as they possibly can in the first 100 days. On top of that, they're gonna, and Trump in particular will try to have influence way beyond the 4 years that he's in office. Whether he'll succeed on that is of course another question, but he'll certainly try, and maybe JD Vance is going to take the torch afterwards or whatever it may be. And so let's assume for a moment that they are effective in cutting the regulatory burden. That would be a bump higher in the yield. And then it is feasible to say that the policies they introduce are going to push growth aggressively. And it is feasible to say that the Federal Reserve is going to be asleep at the wheel again. It's going to be late reacting to that. So in that sort of environment, absolutely, it is possible for long-term rates to go significantly higher. But if you just listen to what I said, there are so many ifs in there that is one scenario, right? The one thing I would say is that somebody who's betting on rates to come down, then there you can buy the long bond. If you're betting on rates to go higher, you have an uphill battle. You have a negative carry trade. And so you've got to get the timing right. And I do not recommend anybody taking on that trade unless you can afford to lose the money that you're putting down, because there's just so many cross currents that drive these longer term yields. Shorter term rates are difficult enough to forecast. The longer term ones, it's wonderful to procrastinate about them, but putting money down on them is a completely different game.
All right, so you're probably going to deliver a similar answer to this question because it's tied in many ways, but again, on the minds of a lot of people. Where do you see mortgage rates moving after today?
Well, I had some commentaries today that may actually get the Fed to move to cut rates because they don't like where mortgage rates are. The mortgage rates are obviously a huge headwind to the housing market. The longer term refinancing rates are a huge challenge to the commercial real estate market. That if short term rates go down, the longer term rates go down. The Federal Reserve has given many institutions a lifeline. Yesterday, REITs were one of the worst performers, and because it doesn't seem likely that they can clean up their books sooner rather than later. Now, people going back to office maybe is going to help and whatnot, but it's rather than tackling many of the issues, the Federal Reserve converted an acute into a chronic problem. And I already then said it's a bit like the savings and loan crisis. It takes many, many years to clean up the bank's problems. One of the reasons we haven't had a recession is because the Federal Reserve has these put options in place and is somewhat micromanaging the economy. But if you want lower mortgage rates, you've got to bet on a recession, on a good old-fashioned recession. So if your outlook is that the economy is going to be super weak, then the mortgage rates are going to come down. Otherwise, there's really very, very little reason for mortgage rates to come down too aggressively.
All right. I would love to continue to dig with you into what the implications of that are for, consumer spending, all the knock-on effects of that. If houses continue to remain at these really unprecedented levels of unaffordability.
Well, but the one comment I'd just like to make on that, because
sure.
the question is, well, what's about all this cash that's on the sideline? Is that going to come to the market, going to chase the markets? And it turns out there isn't so much cash on the sidelines anymore. The consumers are have somewhat run out of their savings. And so that's all going to be very interesting. Now, part of it is, of course, the optimism that people have. And if people are optimistic enough, they'll take out debt to continue spending. But we talk quite positively here.
Well, sorry to interrupt, but we're seeing some signs that they're beginning to tap out on their ability to take on more debt too.
Yes, I think that is correct. They'll try, right? But I just want to mention, right? We talk quite positively here. There are some headwinds to this economy, right? And if the Federal Reserve hadn't been micromanaging so much, I think we would be in a recession right now. And so the reason why we talk about these yields and the growth potential is because structurally there will be changes. One of my mantras during the financial crisis has been the best short-term policy is a good long-term policy. The short-term pain is necessary for long-term growth. And so if you put in place long-term policies such as less regulation or a tax regime that's more favorable for growth, I think that is very helpful for the financial markets. In the short term, of course, and the consumer in particular, yes, the cash you have in a bank account and your borrowing power does matter.
Okay. Somebody here asked, what are Axel's clients investing in? I'm going to tweak that question more to, given not just today's developments, Axel, but what you and your team there at Merk Investments are analyzing and taking into account. I mean, obviously, you guys are in the gold markets and the gold mining markets every day, but what general investing strategies / assets do you think make more sense given your outlook of the next 6 to 12 months?
Well, I give you a few answers or non-answers. Institutionally, we're biased. We have about 1.7 billion in gold and gold mining, and I don't want to talk about those too much here. Come to merkinvestments.com and go from there. What we do there. Whenever the most important thing is, as an investor, that you have a plan, and it doesn't even need to be a great plan. Just have a plan. Don't just listen to the latest pundit and change your portfolio based on the latest thing that you hear. The next layer on top of that is that think about investing in terms of risks. What risk can you afford, right? You're not going to go broke if your expenses are less than your income. And so once you have tackled that, everything else is really an icing on the cake. And historically, having your money in the stock market is, of course, something that's yielded a good return. That said, a lot of people are concerned about the valuations in the stock market. And if you are, how do you diversify, right? You can move to cash, but if you move to cash, you get the whatever, assuming it's not a bank account that doesn't pay anything, it's a money market fund, you're getting a decent return, but you're going to miss out on the rallies. And that's just the price you pay for that. Your goal in life is probably not to beat the S&P 500. I happen to like the gold and the gold mining space because I happen to be concerned about equity markets, and I happen to think that the incentives of governments and investors are not aligned. In the gold mining space, I think the active management is way underappreciated, which means there are extraordinary opportunities in there, but it's an extraordinary volatile space as well, right? With rates where they are, I wouldn't play games on the yield curve. I have done that, by the way. I don't do it these days. I don't think it's worth the risk-reward ratio. I don't think is worth it. And as you well know, and we've discussed in other sessions, I've done things outside of the traditional markets, including in investing in forest and real estate and other things.
All right. And folks, I'm going to start wrapping it up here. One of the, if you guys took the survey I sent out the other day, one of the bits of feedback that I heard was, one, folks really like this, which was great to hear, but sometimes these things get a little bit long. And so I'm going to try to be good about keeping them around an hour. Axel, 2 last questions for you. First one is for folks that want to follow you and your work in between your appearances here whenever we have a Fed meeting like this. And by the way, we've got one next month, so we're going to be doing this all over again in just a month. Where should folks go to stay on top of you and your work?
merkinvestments.com is probably a good place to start. We have a webinar about our gold mining fund that we just had. That's if you want to learn about gold mining. We have a newsletter. Twitter is, of course, a good place, or X these days, at Axel Merk is my handle, where I tend to be quite active during central bank meetings, including today. I'll also tweet during the European Central Bank meeting. I cannot discuss any products on social media, but anybody who has any questions is always very welcome to reach out to me.
All right, great. And I had a whole bunch of questions here. I know there are a few more asked in the chat I didn't have time to get to. Is there anything about today's news with the Fed that I didn't ask you about yet that you think is worth sharing with the audience?
I alluded to it in the beginning. Why is it that we care? And the related thing is, why on earth are they holding these press conferences? And if there's nothing to be said, then they shouldn't say it. And so today was one of these events where I think it would have been far more fruitful if they didn't have any meeting, if they didn't have any public discussion. Because if the only goal of the discussion is not to say anything wrong, why on earth do you have it in the first place? And so we live, of course, in an era where everybody wants to hear themselves, and I guess we're talking too, right? But it is sometimes it's better to talk less, and I think you quoted me on that already earlier. And I'll sometimes try to take that to heart myself. So if I don't tweet for a while, it probably means I have something very, very meaningful that's going to come up down the road.
All right. Well, Axel, thanks so much for coming on with us again. I've actually been getting some private messages from folks, and one or two in the live chat there, people just saying how much they appreciate us, and this is largely you, taking these Fed speak utterances and trying just to sort of boil it down into regular person language and help the regular person, track what's actually happening here.
We try. Yeah.
We try. All right, folks. Well, look, thanks so much for joining us. As a reminder, please take a quick second before you go. Hit the like button. Obviously, if you haven't subscribed to this channel yet, subscribe to it. If you have subscribed to it, make sure that little bell icon is checked. We've been hearing that folks have been finding it's been unchecked and that they haven't been getting alerted when we have new videos going out. So double check to make sure you're still subscribed with that bell. And then obviously, if you want to put this information into action, and this is what thoughtful money is all about, right? Information's great, but it has no value unless you put it into action. If you want to put it into action into your own portfolio and you would like some help with that, highly recommend that you seek the counsel and guidance of a good financial advisor who takes into account all the macro issues that Axel and I have talked about here. To be honest, when you layer those requirements on top of themselves, the universe of folks that meet that gets to be pretty low. But if you've got a good one who's doing that, great, stick with them. If you don't, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com. There's the URL right there. Only takes you a couple of seconds to fill out that form, and then you can talk with one of these advisors. These are the folks you see with me on this channel week after week. And again, these consultations totally free. No commitment to work with these guys, just a free public service they offer. Folks, I really appreciate you tuning us in with us. It looks like from your feedback here in the live chat, you'll like us doing this, so we'll continue doing this, Axel and me, every time the Fed meets and Powell gives a press conference. Axel, we'll see you next month. Everybody else, thanks so much for watching.
My pleasure.